the banks are really, I believe, in trouble here. And when you talk about lowering rates the way that the Fed does, it's in a very methodical fashion. They're not going to drop rates by 200, 300 basis points. They'll drop them by 25 or 50. And I don't think that.
Ready to decode the financial puzzle? The Fed's recent murmurings about rate cuts have unleashed a tidal wave of activity in gold and silver markets. Andy Schectman is your guide on this expedition, unveiling the hidden narratives and potential strategies emerging from this extraordinary market surge. Brace yourself for an insightful journey through the intricacies of precious metals investing.
That's a portrait we'll never have. And I think, Jerome Powell's attempted imitation of Paul Volcker has fallen considerably short. I mean, to me, this is not a signal that the Fed has beaten inflation. To me, it's more along the lines of that they've given up on fighting inflation. And it's interesting that they make the announcement to start cutting before they get to their target of 2%. I mean, by their own numbers, we're at 4%. But if you take a look at John Williams' shadow stats, even looking, he'll show you what the way the numbers were in 1980 and then again in 1990. And in 1980, it was a much more accurate reflection. The CPI was 1990. They started making some changes, but even using the 1990 model, the measurement of inflation right now is 8%, not the 4% that we're being told. So they're giving up on inflation with, fighting it anyway by raising rates with it right now at 4% by the CPI numbers and double that amount if you go back and use the numbers that were a much more accurate reflection of the way it once was. And, look, I think the Fed is trapped. To be honest with you, I think they realize that if they raise rates, they break the system. But the funny thing is that if they don't, they signal an end on austerity. They're telling the world that they will choose inflation over the tough decisions forever. They'll never balance their or normalize their balance sheet. And I think what this really shows is the dangers of a highly leveraged economy where asset valuations have lost all price discovery. And it's no coincidence that this is an election year, and I think it's quite obvious that Powell was bullied, I guess you could say, by the White House and maybe even by Wall Street into giving up on trying to in any shape or form normalize things. And look, you still have inflation, which is much higher right now than normal standards. And I think what this will really do is reignite inflation and will make things much worse in the end. It's a game where I think maybe the realization that the market is more powerful than the central banks, because I think if this signals to the rest of the world that, why would we trade our goods for a dollar that ultimately will follow the path that all other currencies have followed forever, and that is inflation over the tough decisions. And not to mention, we have a government that is addicted to spending. And, like the laws of inertia, a government in decline will remain in decline until they start to make some responsible decisions. This is not a responsible decision, nor is the ridiculous amount of spending. The Congressional Budget Office, Chris, said that in 7 years, by 2031, 100% of all the tax revenue, this is the government's own admission, will go to pay just the interest on the debt and all the mandatory entitlement spendings, like Social Security, which is already nearly 70 trillion in the hole. So think about this. How is it that a country would even think of remaining the world's dominant superpower economically and militarily when in 7 years we will have to borrow money for every discretionary thing, including funding the military? This becomes a situation that is unattainable. This becomes a situation that doesn't end well. And it's as if our policymakers ignore the laws and the rules of history and just hope that they can kick the can so far down the road that, it allows them to continue to stay in power a little longer. But it's very disappointing. And I don't know, shame on Jerome for saying that Volcker was his hero, because Volcker would certainly not look at him as being anything other than a sellout. I don't think the rate cuts are substantive enough. They're not substantial enough. Dropping a quarter point here or a half point there, it's not going to do it. And you know, we've seen so much money leave the banks going directly into the money market accounts, chasing yield. I mean, the banks, even with rates where they've been, they haven't passed those rates on to the savers. I mean, you look at the what you get in a savings account, it's still under 1%. Yes, you can go to a CD, lock your money up for a year and get 4.5%, or go to a money market with overnight liquidity and get over 5%. So the banks are really, I believe, in trouble here. And when you talk about lowering rates the way that the Fed does, it's in a very methodical fashion. They're not going to drop rates by 200, 300 basis points. They'll drop them by 25 or 50. And I don't think that that really is going to matter much. They are always late to the to the party, and I don't even think that the full effect of the rate hikes have worked their way through the plumbing system yet. And I you talk about, do they see something that we don't? Yeah, I mean, maybe they see that there's big trouble ahead for the banking system, and they're trying to do what they can to mitigate it, but in the method that they will choose, it's certainly too little, too late, as far as I'm concerned. Now, you want to fix the problem with the banking system, go back to zero federal funds rate, and fine. But what does that say to the rest of the world about the dollar being the reserve currency? And why would anybody want to trust us with selling us their goods? People say, well, the dollar's still the best of the best. Well, is it? When we're running those kinds of deficits, when we're dropping interest rates to pay homage to the fact that we can't never normalize our balance sheet, that we will continue to inflate as our chosen methodology and keep interest rates at zero and create all of these distortions and these anomalies in asset prices. That's the problem to begin with. All of the problems that we see in this economy, to me, center around interest rate manipulation. And that then has a byproduct of gold and silver suppression, because they are the canaries in the mine shaft. But it's been the suppression of interest rates which has created perceptions and illusions of prosperity and incredible distortions within asset prices. So it's one of these deals where I think they're damned if they do and they're damned if they don't. They've got themselves trapped, and it'll be interesting to see how it plays out. But if I had to guess, what the Fed intends to do is far too little, too late. Look, they're talking about lowering rates, but continuing to QT. They're going to continue to sell off their balance sheet as they ease rates a little bit. I mean, it's almost as if it's double speak. I don't think, short of really dropping rates substantively, that whatever they're going to do is going to matter much whatsoever to the banking system. It's almost unfair this time of the year to make that type of a appraisal, in that, if people are anything like me right now, and probably like you're ready to check out and, enjoy what little time of the holidays is left, and Christmas and New Year's. And, I think people are a little bit distracted right now, traveling or with family or making preparations. I think people are suffering from information fatigue, from there's so much going on and it's happening so fast. It's changing in every facet of our life, spiritually, morally, politically, geopolitically, economically. There's something every day to rile you up or make you shake your head and just say, geez, more of this crap. Yeah, and it's only going to get worse. And when you see these types of decisions, which appear to be politically motivated, and it's sad to think that the Federal Reserve would be politically motivated, but it's hard to believe it's not by looking at these decisions. And, it's like, I think that much like it takes time for the interest rates or the Fed policy decisions to work their way through the system, I think it's this information has to work its way through the system. But to the public is blissfully believing perhaps that a soft landing is upon us. And I think hope springs eternal, but it will take an event that, geez, maybe this isn't the case, for people to wake up and start looking at gold and silver for what they really are, and It's interesting though. We have had a lot of money management money, a lot of family office money, a lot of what I would call sophisticated money come to us as of late, and I don't know if the word is capitulate into moving into precious metals at the behest of their clientele, but um, it's an interesting deal where more so than we're used to seeing, we're seeing managed money come into the space, and that doesn't surprise me. They're typically a step or two ahead of the public as well. And look, you haven't seen central bank buying slow down. If anything, you've seen it increase. And they're the most well-funded and well-informed players on the planet. They know the playbook. They're ahead of the public. And I think it's one of these deals where you can't trust your lying eyes. You got to trust your gut and do what the big money is doing, not what the supposed talking heads are saying. Yeah, remember, I mean, they're doing that in the face in real interest rates and gold supposedly move in inverse direction of one another. And that's the issue here, is that even with the nominal rates where they are factored against even the lying metrics of inflation, the real return is negative. When you put it against the CPI the way it used to be calculated, the real return is as much as 4% per year compounding negative. So, yes, interest rates would have to go much higher, but I would also say that, for the very first time, in the first time in 45 years, gold is less volatile than the 10-year treasury. And from a historical point of view, government debt, it has a very shallow history of being an asset. I think there's a good portion of the world that looks at the big picture, like China, like Japan, like Saudi Arabia, these countries who have not been rolling over their debt and in fact have been selling it, and it appeared by all appearances in favor of commodities, real things that you can hold rather than debt instruments like gold, which is a tier one, like silver. We've seen, India import more silver again. I think they did 20 million ounces in November after 60 million ounces in October and 304 million last year. And so the big money is using the suppression, is using the rhetoric as a cover to shed treasuries, which I think is something that carries risk that no one really ever thought about before, and moving into something that carries no counterparty risk that you hold in your own possession. And that, to me, is really one of the big benefits that the public will realize, maybe after, in large part, it's too late, that gold and silver are assets, if physically held, that carry no counterparty risk. They're not simultaneously someone else's liability. And in a world that is so systemically connected and systemically sick, I think there's a lot to be said for removing completely and totally counterparty risk. I guess I'd sum it up by saying you have a better chance of being ripped off by the system than you do by a would-be burglar digging through your home looking for gold and silver. And I mean that to be true, 100%.
Thank you for tuning in. Andy Schectman has provided a comprehensive analysis of the recent market surge in gold and silver. Remember, the financial landscape is ever-changing. Stay tuned for more expert insights and strategies. Hit subscribe to stay updated on all things related to precious metals and investing. Thanks again.